Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning and welcome to Friday, the end of the week. This is Peter Lewis welcoming you to my podcast Money Talk for Friday the 3rd of November. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, the Bank of England left interest rates on hold at a 15-year high of 5.25% and warned that policy will stay tight for an extended period of time. It was the second successive meeting that the UK Central Bank has left rates unchanged after 14 rate rises since December 2021. It warned that the UK economy faces stagnation. The BOE said growth would remain well below historical averages over the medium term, and inflation is set to remain more persistent than it previously expected. The Hong Kong Monetary Authority left its base rate at 5.75% on Thursday, the highest level since December 2007, hours after the US Federal Reserve left the Fed funds rate unchanged for the third time this year. Leading local banks, HSBC, Standard Chartered and Bank of China, said they will keep their best lending rates unchanged. Japan's Prime Minister has announced a stimulus package worth more than 17 trillion yen, that's about $113 billion US, in a bid to address higher living costs. Fumio Kishida said on Thursday that about 13 trillion yen of the package will be funded by a supplementary budget for the remainder of the current fiscal year through March 2024. And the package will fund measures to cushion the impact of inflation on households, help firms raise wages, and offer support for domestic investment and growth. Investors have poured into US and European government debt after the Fed and other central banks signalled a possible end to the rate rise cycle that's weighed on the bond market for more than a year. The yield on 10-year US Treasuries has tumbled by over 30 basis points in 2 days. On Wednesday, in the immediate aftermath of the Fed decision, the 10-year yield dropped 19 basis points, the biggest fall since the collapse of Silicon Valley Bank in March, and it fell another 12 basis points yesterday to 4.67%. In October, it reached a 16-year high of 5.02%. On today's programme, I'm joined by Francis Lun, the CEO of GEO Securities, and Frederick Chu, Managing Director of Magnum Research. With a view from South Korea is Peter Kim, Managing Director and Investment Strategist at KB Securities in Seoul. And don't forget to take a look at my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks surged in a broad rally a day after the Fed kept interest rates on hold and ahead of the US jobs reports later today. The S&P 500 jumped 1.9% higher and closed at 4,318 in its best day since April. And it was also the first time the S&P 500 posted back-to-back gains of more than 1% since February. The Dow closed 565 points higher, or 1.7%, to settle at 33,839, its best day since June. The Nasdaq Composite climbed 1.8% and closed at 13,294, marking its best session since July. After the bell, Apple reported fiscal fourth quarter earnings that beat estimates, but the iPhone maker recorded its fourth consecutive quarterly sales decline. Apple reported a 1% fall in revenue from a year before to $89.5 billion as demand for gadgets like Macs and iPads fell. Analysts had been expecting revenue of $89.2 billion. However, Apple's earnings per share rose 13% to $1.46 thanks to higher margin from services. Wall Street had been expecting earnings per share of $1.39. The results suggest that it is facing, though, a sharper slowdown in China than feared. Apple shares fell over 3% in extended trading. Brent crude oil futures rose 2.4% to above $86.65 per barrel on Thursday as risk appetite came back to the markets. Gold prices were just marginally firmer despite the weaker dollar and lower yield environment. Gold climbed 0.2% to $1,986 an ounce. The US dollar index fell below 106 at one stage on Thursday, retreating sharply from one-month highs and tracking a decline in Treasury yields. It ended the session 0.5% lower at 106.15, and the dollar's on track for its biggest weekly drop since July. The US dollar held above 150 Japanese yen, ending the day 1/3% lower at 150.45. In China's onshore markets, the yuan was unchanged at 7.316 renminbi per dollar. On the mainland, the Shanghai Composite rose 0.1% to 3,026. The Shanghai Composite is virtually flat in 2023 so far. Shares in Hong Kong surged after the Hong Kong Monetary Authority maintained its base rate at 5.75%. The Hang Seng Index jumped 206 points higher, or 1.2%, to 17,308. The Hang Seng Index has declined almost 13% this year, making it the worst performer among major global stock indices. And the Hang Seng is projected to open about 140 points higher this morning. That's about 0.8%. Looks like the index is going to start the day around about 17,370. And don't forget, you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
It's Friday, we're happy. Francis Lun is always happy, whatever day of the week it is. Welcome, Francis, the CEO of GEO Securities.
Yeah, good morning, everyone.
Nice to see you. And also, the ever-happy Frederick Chu is with us, Managing Director at Magnum Research. Good to see you, Frederick.
Morning.
It's been a busy week, hasn't it, for central banks? Let's go through a few of them. Start with the Fed. That was probably the big one, wasn't it? Left interest rates on hold at a 22-year high. The Fed funds rate is now at a target of between 5.25% to 5.5%. It's been there since July, but the Fed did keep open the possibility of additional monetary tightening because the US economy still remains pretty strong. Francis, the markets have taken this in quite a dovish way. They've sort of interpreted Jerome Powell's comments as basically signalling we're at the end of the rate hiking cycle. Do you think they're right to do that, or is this a bit too early to say?
Well, actually, it depends on the inflation figures. I think the market believes that the inflation has run its course, and the Federal Reserve does not have to raise rates to combat inflation. But if you have high inflation figures for 2 months and then oil price spike again, then maybe the Federal Reserve will raise rates again. But right now, people seem content that things will be getting better, and you see global stock market surging, and even poor Hong Kong and China rose.
Even they managed a modest rebound.
Yeah, that's right. So maybe we are seeing the end of the bear market. The 2023 bear market is really suffocating, really.
What do you think, Frederick? I mean, I'm wondering, you could interpret what Jerome Powell said in a couple of ways. I mean, on the one hand, he said no decisions have been made about the next meeting, and he said that, the bond market was doing some of the tightening for him, but of course that's unwound a bit now. But then on the other hand, he did say that he wasn't sure that rates were still restrictive enough to bring inflation down. So, if you look at that comment, that suggests we're not there yet.
Yeah, I think this meeting has been greatly aligned with the market before it happened, and the projection is obviously on the good side of things, that it's going to be the end of the rate cycle. I think for if we want to take a wild guess into what December is going to look like, I think two things is quite critical in terms of projecting the way going for inflation. One is the labor market, which is the wages primarily. It's quite strong in terms of its growth. That's one thing. And secondly is on the consumer confidence, which the past figures of last month has been also quite strong. So spending is quite strong, wages are quite strong. So that could put some pressure on the inflation itself. So I would probably think I'm a bit reserved in terms of what December is going to look like. But then another indication I think the market should have taken, it's the rates. Cost of funding is going to remain high, for the next at least 2 or 3 quarters, which means that it's going to hurt the investment sentiment somehow.
Are you seeing signs that maybe the US economy finally is starting to ease, and as a result of all these rate rises? If you look into some of the data, for example, layoffs are increasing, aren't they? We saw that in the jobs, in the unemployment data last night. I think they're at a 4-month high now, and we're hearing of layoffs in the financial and the technology sector. Do you think that maybe we're going to start seeing now the economy slow?
Yeah, we've been hearing like the employments within, especially the technology sector, has happened already. 2 quarters before, but it seems like it hasn't really affected the hiring market. I think the primary thing is after COVID, the U.S. labor market is quite tense, and if obviously we see some slowdowns and we see some cool down in the labor market and the economy, that would be a ironically, that would be a good sign to what the Fed is taking step of.
The thing is, Francis, this is all very volatile, isn't it? Because all we need is a bad inflation number at the next one, or maybe the jobs data tomorrow, later today, and then suddenly this can all unwind very quickly, can't it?
That's right. You see, UAW won a 40% average increase from the big three autos, and other unions will demand the same. And that demand is highly inflationary because that puts the hourly wage for auto workers in U.S. something like $66 per hour. Not counting pension and everything like that. That is something like 10 times higher than the China's. So I think with that kind of labor cost, they are driving the U.S. Auto industry to the rocks. Really.
Do you think so? Do you think because they're already on wages, they're not particularly competitive, are they, with the foreign
they're absolutely
car makers?
Uncompetitive.
Is this a problem, Frederick, that we're going to see now wage inflation start to rise because the however you look at it, the UAW, the union for the automakers, it won, didn't it? It won big time.
Yeah, it's gonna put pressure on the cost of the manufacturers, and if, like I said, if the cost of funding stay high for the next 2-3 quarters, that's going to affect a lot of things like financing rate is going to be high, short-term cash flow is going to have pressure on some of the SMEs, and then investment return is going to be hit. It's going to also going to take hit. So eventually, high cost funding, even though the U.S. stopped raising rates, I think the high cost of funding is going to affect the P&L of the corporates, and eventually it's going to slow down the economy. But it's just a matter of how long it's going to take.
Now, what about here, Francis? The Hong Kong Monetary Authority left its base rate at 5.75%. That's the highest level since December 2007. Maybe what was more important is that the leading local banks, HSBC, Standard Chartered, Bank of China, said they're going to keep their best lending rates unchanged. People had been worried that maybe they might raise their rates. The problem is, though, Francis, the economy here, even though it did grow year on year, it's barely growing sequentially. It's just up 0.1% from the last quarter. Do you think this is going to help at all, the fact now that the rates seem to have peaked here as well?
Yeah, it does not exacerbate the problem because last month, I think the Monetary Authority announced that there's an increase of something like 10,000 cases of negative equity in the mortgage holders. I think if you increase rates further, then more people will fall into the negative equity trap, like in 2003. I think in 2003, more than 100,000 cases of negative equity. Now we are only 1/10 of that. But still is a drag on the economy. I think important thing is that the property market has to go up again. I think what is hurting the market right now is not only the people are going to China to spend their money, and also the property market is still falling. And it doesn't help the consumer sentiment.
I think property prices, they're about 15% lower than their peak now, aren't they?
Well, people are saying something like 17 to 20.
Really? Okay.
Yeah.
Frederick, what do you think here? I mean, obviously, a relief that the HKMA and the banks have left rates unchanged, but really, our economy is barely growing, isn't it? That's really the problem.
Yeah, I think that pretty much makes sense. I mean, Hong Kong is in a dilemma whether, you can be following the Fed, obviously, and then your economy is closely tied with with mainland China, where mainland China is at the, kind of like a modest interest rate, where type of like a deflation zone. So Hong Kong is really not in the course of, following the U.S. in terms of the monetary policy. Property market, it's also one thing apart from the affordability, but also the cash flow of owning a house for investment, for instance, it's going down substantially after the COVID. So I just don't think Hong Kong can maintain such a any upside on the rates. Bank deposits is already eating up a lot of the investment interest. So if that prolongs, is going to be put more stress on the Hang Seng.
Okay. Now, the Bank of England, they've also been in action, or maybe they weren't in action because they left rates also unchanged at 5.25%. They warned, though, that policy is going to stay tight for an extended period of time. That's the second meeting now. The Bank of England has left rates unchanged, but it warned that the UK economy faces stagnation. The BOE said growth would remain well below historical averages over the medium term, and inflation is set to remain more persistent than it previously expected. This is, Francis, this is stagflation, isn't it?
Yeah, definitely. Yeah, I think inflation hit UK really very hard, and especially in terms of energy prices. And for many families, just heating and food and rent eat up all their income. They don't have anything left. I think that's the problem. People are falling into poverty, and wage increase has not caught up with inflation, and that's why UK cannot afford another rate increase.
But it really needs it. If you look at where inflation is, they really should be raising rates further, but at the moment the economy is looking so weak that they don't dare, do they?
That's right. It's better to leave rates unchanged because hopefully inflation will bottom out. It's predicting growth to be flat this quarter, and then only a 0.1% expansion in the final 3 months of the year. I think, Frederick, the Bank of England's in a bit of a hole, isn't it?
Yeah, I mean, winter is coming. It's going to be tough for the next several months. I think inflation it's going to stay there. It's going to stay there for a bit longer time.
Okay. Well, one other central bank we should talk about, the Bank of Japan. It's left its interest rates negative. It's the only central bank in the world now that's still got negative interest rates, but it did remove the upper band of the yield curve control target, which was 1%. I have to say, I'm still confused by what the Bank of Japan is doing here, because they've removed it, but they haven't said now what their target is. So, is there a level at which they would step in and start buying bonds, or is it gone altogether? They don't seem to be clear about what the target is and what they're going to do.
They don't know what they are doing, basically.
I didn't want to say it that way, but
I think when your exchange rate versus the US dollar is falling into really year low and still falling, I think you have to do something to stop that fall in the yen exchange rate. But of course the central bank wants more inflation because before this year Japan has no inflation, and now they have something inflation rate of 2.8 or something like that. So which means it's getting to be normal for Japan now.
But it's the wrong sort of inflation they're getting, isn't it? They're basically importing inflation, whereas what they want is some domestic inflation and hopefully driving wages up, but wages aren't going up. So people are really feeling the pain here. This is presumably, Frederick, again, the Bank of Japan's sort of got a policy that it would really love to let go, wouldn't it? But it just can't seem to find a way out of it.
Yeah, I think they're confused as much as the investors. If you look at, apart from inflation is finally growing, you got fund flows into the Japan stock market from foreign investors. But other than that, if you look at industrial productions and all other major economic indices, economic indicators, it's not really growing. So all in all, I think Japan is still benefiting from global fund flows rather than that there's a pickup in its own economy.
Okay, well, what about China's economy? We've had plenty of data this week here as well. Looks like manufacturing, it's slipped back into contraction, hasn't it, Francis?
Yeah, it's both set of data, the official and the Caixin PMI came in at 49.5, which is worse than expected, and back into the contraction mode. That's why the market crashed on Tuesday or something like that. Yeah, and China just does not cannot seem to get its actions right to really lift the economy out of the doldrums, because the manufacturing is still way down, and it is not like in previous boom years. You have manufacturing activities rising 10% or more each year. I think Chinese economy is reaching a mature stage. Then you will have to be satisfied with 3 or 4% growth every year.
And even services, that's at a 10-month low now as well. That's only just above 50, so not far away from contraction as well. What do you make of this data, Frederick? Were you concerned by what we're seeing here?
Well, domestic demand is just weak. We're seeing consumption is weak. Stock market is weak. Basically, the people are either stuck in a paper loss on their investments, or the other way around. The property market it's not giving them any benefits as well. So I think. Well, if you take it on the good side, is people's money are still there. They just tend to put it in the bank rather than spending it. So yeah, the spending sentiments it's low, but it doesn't mean that the money has evaporated or something. It's just they do not have the interest into spending. But now China is moving into a consumption economy that relies on domestic consumption. So it becomes a bigger piece that affect the service PMI and etc.
But the consumption in China is nowhere near the levels where, as a percentage of GDP, that you see in other countries, is it? It's way below. I mean, in America, it's
that's right.
It's more than 2/3 of GDP. Whereas what in China, I think it's about 1/3, isn't it? If you're lucky.
Yeah, but China has 30% savings rate, which actually that cushion the fallout from the property fallout, because most people put their money into savings, not into their properties. Otherwise, the economy will be in chaos.
Yeah.
The Caixin survey in particular is a bit worrying, isn't it? Because this is the smaller mid-sized enterprises who are basically 80% of the job creation in China. It suggests that they're not going to really invest and hire more people, are they? So this is going to have a knock-on effect on jobs, and in particular the youth unemployment rate, which is already at a record high.
We have to recall our ex-premier Li Keqiang and call the what do you call the roadside economy. Let people start their own small business and make some money, because most Chinese people are still quite poor. Of course, the official news channel will never admit to it, but that is a fact. And if the state-owned enterprises and if the privately owned manufacturers and exporters are doing well, then you have to find some way to boost the economy.
Frederick, what's the way out of this?
It's tough because the SMEs or small enterprises in China has been facing a problem about borrowing, financing ever since. So it has never been resolved. Funding just cannot come down to this piece of population. So running a business really depending on how quick the turnover will be. If demand is strong, then you got more product turnaround. Then you're going to be it's going to be sustaining. But otherwise, if demand is weak, then you're going to be stuck in some short-term cash flow pressure, which is right now what we are really seeing. The state, it's difficult at this moment in terms of helping this sector, because first of all, you can't have a loosened monetary policy at the moment, because in anywhere outside of China has been having a high interest rate, so you want to limit the yield difference at the moment. And secondly, the debt problem in China within central level or local government level, it's up to somewhere that is really need to deal with. I mean, our debt to GDP is over 200%, which is quite substantial, and the local government financing problem is also another thing that the central government is worrying. So I think it's really not there for the Chinese government to do anything until I think when U.S. has a very confirmed view that interest rate has capped, and now we are looking into a roadmap for potentially rate decrease. Then I think that would be the time when China is more confident into doing something more.
On the local debt issue, we had this twice a decade Central Financial Work Conference earlier this week, which is setting basically the financial oversight for the next 5 years. But at it, they said they're going to come up with a long-term mechanism to resolve local government debt and expand borrowing at the central government level. But they didn't say what exactly they were going to do. So how is this going to be resolved?
Well, they always insist on that the local governments will raise their own bonds. Because I believe I came across a figure of something like 10 trillion yuan in debt for the local government. That is really quite a lot. Or 100 trillion. I don't know. I think it's 100 trillion. So it's almost as large as the national economy, the GDP. So I think the central government will be unable to underwrite it all by itself year after year, because all 32 provinces and cities have budget deficits, so they have to finance their own.
But they can't raise any more debts, can they?
If they can't raise any more debts, then they fire people, like what they do in Argentina.
So this is, I'm wondering, Frederick, what they mean by resolve. At the moment, there are losses, very big losses that the local governments are sitting on. Those losses aren't just going to disappear. So who's going to bear these losses? Is it going to be the central government? Is it the local governments? Is it going to be a mixture? Is it going to be the banks? Where exactly will these losses end up?
Well, if you say it's banks is going to bail out, then which means they're going to be the SOE banks, which then it means it's going to be the central government, which is, I think, is the easier way. I think for the financial working group, what they are looking at, it's beyond one single problem, because right now, because of the property crackdown, we're seeing multiple problems that coming from the property development down to local governments, and then down to the financial sectors where the wrap products are being sold to individual investors, and where the individual investors are not redeeming back their investments. So it's a chain of things that's been caused by the property crackdown. So there's a bigger problem that the central government needs to look into, and then it also comes down to more politically concerning how the actual financial system in China is working. You have a mega, regulators now that sit beyond CRC, CSRC, and CBRC, and what this group of people, which are not necessarily financial experts, when they when you have them to monitor the financial system, what sort of things that
what are they good? Is it a good idea, do you think, to have a super regulator like this, or is it?
They have to install some discipline, financial discipline on the local governments. They haven't had any financial discipline for 50 years.
But they're also sort of, it's moving away from a market-orientated, well, even more from a market-orientated economy, isn't it? Because this super regulator is even going to decide who can IPO in effect. I mean, we're seeing it at the moment in Shanghai. Lots of companies are just failing, all these rules and can't IPO. So rather than the market deciding, this is a good company and it can IPO and this is the value, these regulators seem to be deciding it, which is the worst way to do it, isn't it?
Yeah, that's right. That's the problem, that the central government now wants to get the hand into everything and anything. And look at their crackdown on the big tax. And that was a disaster.
Well, that's the thing. When they do look into it, they seem to get it wrong. They seem to come up with the wrong policy at the wrong time. Like the 3 red lines, it was a nice idea, but the problem was the horse had already bolted. The property developers had already loaded themselves up to the gills with debt, so it was too late to come up with these 3 red lines to stop them becoming encumbered with debt. Yeah. All too late.
I think if we take a step back and if you look at the current regime, the main attention is what has been created by a market-oriented economic structure for the past 10, 20 years or beyond, and they're going to fix it now. So fixing it means, for instance, the local government has been expanding, development projects on infrastructure, real estate, etc. That causes the high debt level, and that's market oriented somehow. Yes, you say it's less of discipline, but it's market oriented. But now, because of the less of discipline, we're going to stop that. We're going to rectify that, which means that now you have to stop. So the stopping period, it's gonna be most suffering until it's kind of like you see the light of fixing.
And it's going to weigh on economic growth, isn't it?
Absolutely, yes. And the current regime will not be concerned by the short-term crash on the economy. But one thing that most matters is to fix it.
Right. Okay. Now let's finish up on the markets. Here in Hong Kong, we did get a bit of a rally yesterday, but everything was rallying. There was a big risk-on move yesterday. Bond yields fell. Stocks went up. We had a huge rally on the Nasdaq overnight. Nevertheless, the Hang Seng, despite that, it's down 13% this year. It's the worst performer among global stock indices. On the mainland, the Shanghai Composite, it's basically flat for the year. It's gone nowhere. Any sign of the pain being over, Francis, for us?
Well, at least people are much more optimistic right now. Even though the turnover is quite low, it's still $71 billion. But at least you have some sectors doing well, like the electric car sector. Xiaopang and Li Auto, they are doing well, and even the big techs like Alibaba and Tencent rose a little bit. Of course, the banks are not doing so well, but overall, I think it's much more optimistic market than last week.
So you think the low is in?
I think last week we fell below 17,000 momentarily. I think that should be the low for the year.
Okay. Are you optimistic, Frederick?
I kind of agree with Francis on the low, but I'm not necessarily optimistic. I think the Hang Seng, it's still on a clear downtrend. where on the upside, the 15-day moving average is quite resisting, but on the downs, it's somewhere around 168, 169 is probably going to be the low. The A shares, it's the Shanghai Composite. I mean, it's on a 10-year support, trend line support at the moment. I think that's why it causes the rebound. And I don't see a substantial upticks on the stock market, but that would be somewhere 28,000, 29,000 would also be the low for this year.
Is there a catalyst that we need to see that's really going to get a sustainable rebound going? It's all very well not going much below 17,000, but we'd like to see a bit more than that, wouldn't we? What could a catalyst be?
I think we are waiting for the Chinese economy to really grow at more than 5% a year. We are not talking about 10 or 8%. I think we are only thinking about more than 5% a year. If they have recovery in that, especially the recovery of the big techs like Alibaba and Tencent, I think we can have a sustained market rally.
I think for Hong Kong, when the fixed deposit rate comes down, or is coming down, then the stock market will come back.
Okay. Well, thank you both very much. Yeah. Have a great weekend. You heard there Frederick Chu, who's Managing Director at Magnum Research, Francis Lun, who is the CEO of GEO Securities. I'm joined now by Peter Kim, who is Managing Director and Investment Strategist at KB Securities over in Seoul, South Korea. Good morning, Peter.
Good morning, Peter.
Let's kick off talking about the markets. What I wanted to look at is some of the best performing and worst performing assets so far in 2023. Now, if I look at the data, the two best performing stock markets in the world are, first of all, Russia, which is up over 50% now for the first half of the year, and Greece, which is up over 30%. But in third place, the one I wanted to talk about, the Nasdaq. It's had a bit of a rebound in the last few days. It's up 27% now so far this year. Looks like the Magnificent Seven are staging a bit of a comeback.
That's right. Well, I think first of all, the Russia outperforming everything else by far. I guess that needs to be addressed. Obviously, the previous year they had a horrible year, so it's been a one hell of a beta bounce, hasn't it? And I think it's type of the world that we live in, that geopolitical risk linking to fundamentals, the correlations that you would normally expect is not working, and I think that cuts across different asset classes as well as countries. As far as Nasdaq goes, I do think that, as you mentioned already, the few stocks overwhelming the fund flows, and I think that links to what we discussed our previous segment, which was that the retail investors dominating the fund flows over the traditional institutional money. And I think that, as we mentioned, I think it's a trend that's probably will persist for a while. And I do think that investors should practice caution in calling the reversal of that.
And I thought also the other thing you have to be careful about, I suppose, if you invest in markets like Greece or Russia, the currency risk. You better go and hedge your currency, because otherwise you reduce quite a lot of that gain.
Well, that's currencies come and go. So on the way down, you lose a lot more, but on the way up, it's very, very gratifying. So again, for institutional money, that is a risk. For retail investors, they consider it as an added attraction, right? So you see some of the popularity of the leveraged ETFs now. That's so popular, and I think that just goes to I don't know if it's positive, but the retail money investing like it's partially gambling, partially online gaming.
It is, isn't it, for these retail investors? I think when you look at some of the stocks that they're buying, they're sort of buying the meme stocks, aren't they?
Yeah, That's right, including my 3 daughters.
Yes. And now the other big market this year, that's in fourth place at the moment, the Nikkei, up 22.4% so far this year. I think we can thank the Bank of Japan for that, can't we?
Yes, partially, but also I think there is something a little more fundamental going on there. If you look at Japan over the past 30 years, the big drag on the economy was the property market. Property prices declining for over 20 years in a row. I mean, that's that's why they call it the balance sheet recession, right? But property prices started to rise from about 3 years ago, and in a world where inflation is considered bad now, for Japan, it's definitely positive. And the wealth effect that's feeding into the economy certainly has put a good tailwind onto the BOJ's policies.
And also it's got some help, hasn't it, in terms of these corporate reforms that are going on to try and get Japanese companies to improve their returns to investors. There's going to be this name and shame list now for companies that have a book value below 1. Presumably that's helping as well, and particularly foreign investors like what they're seeing there.
Definitely. And I think, whereas Japan had to deal with triple whammy of strong currency, falling property market, and bad corporate governance, all three has reversed. Not in a spectacular way, just the fact that they've aligned together in a positive direction, I think is very powerful. And I think, and I would add a fourth one to that, actually, is that from a fund flow perspective, the major source of investments or destination has been China. And clearly, from my perspective, I see clients looking for alternatives outside of China. And Japan has sort of aligned its policies right at the right time at the right place.
I mean, we've had over the last 30 years in Japan a lot of false dawns in the stock markets, haven't we? But do you think this is the real deal now?
Well, I think it's certainly going in the right direction. I'm not sure whether it's going to sustain for 10 years versus a couple of years, but I do think that Japan has bottomed, and I think it's doing the right thing by its policies. But investors may be a little disappointed if they expect Japan to come in a big, spectacular structural story, because Japan's still move very slowly. And I don't think culturally that has changed. But as I said, I think the three big negatives turning into a positive, I think it's enough for investors to start getting interested, because I don't know of many investors who are overweight Japan, even now. So I think there's a lot of dry powder that could come in.
Well, look, related to Japan, if we go to the bottom of the list and look at what the worst performing assets are so far in 2023, the worst performing asset this year is the Japanese yen, down 15% so far against the dollar. Now, this, even despite the Bank of Japan trying to ease a little bit its yield curve control policy, the yen's sort of given it a big thumbs down.
Right. So that's a double-edged sword, right? For foreign investors who are judged by U.S. dollar terms, it is a drag. But I think over the longer term, the currency should play in favor of its companies, so exporters, and that should provide a lot more longevity in terms of export cycle. But having said that, of course, Japan's yen has been weaker than most currencies, but we're living in a world where U.S. dollar is stronger than everyone else anyway. So I think it's probably not as worrisome, because normally if you had dollar stable and yen weaken, I'm certain there'll be economists coming out for the impending doom of Japanese economy. But we're not in that situation yet.
Do you think that the Bank of Japan, though, it seems to have got itself into a bit of a hole at the moment, doesn't it? I'm still trying to work out what exactly they did this week, because they didn't say anymore what their new target is, or the upper band of their yield curve control policy. So it's not at all clear if there is still a yield curve control policy, is there?
BOJ always works slowly, and they tread very, very cautiously in everything they do to give themselves the back door to reverse it if things work against them. So, and after doing that for 20, 30 years, again, one of those things that I mentioned earlier is that they don't expect Japanese to change their colors just because a few things are starting to work in their favor. And I do think that they are being prudent over the longer term, that their intervention in their bond market, the fact that the government has been the player by far, they're trying to retract from that. Maybe they're even looking at some fiscal prudence to try to cut back on the fiscal balance. Over the longer term, I've never felt that the Japanese policymakers lost sight of their long-term objective. It's just that they were cornered under so many pressures that they had really not many options. But with this recent involvement, they do have a few more options starting to become available. And it'll be interesting to see what pace that they do try to push out something that's a little more market-driven rather than government-driven.
Okay, now the second worst performing assets of the year so far, Hong Kong's Hang Seng Index, and it's the worst performing equity market in the world. It's down basically 13% so far this year. What has gone wrong for Hong Kong stocks?
Well, I think you know more than I do. The beginning of the year, a layup, a sure thing investment call was that with the easing of COVID restriction, that China was going to come bouncing back. And that was very, very short-lived. I think underestimating the changes in the political stance during the lockdown has been a lot more deep in its impact. And I think we're starting to see that sentiment reflected in the market. And I think I don't think a simple artificial economic policies will be enough to reverse that. I think you really need something on the more political direction in order to appease the worried investors.
And mainland stocks are also near the bottom of the list. The Shanghai Composite, it's down 2.6% so far this year. The Chinese yuan down over 6% so far this year, presumably for the same reasons as for Hong Kong.
Yeah, well, if global investors are concerned, I think it's interesting that the mainland investors and consumers also feel the same way, doesn't it? And I think that's a message that clearly is felt by a lot of the key policymakers. But obviously, they have the big boss over there who needs convincing. So I think that Chinese policymakers are still very much connected to the market, understand the message that the market is sending. I think that they need to sort of maybe recalibrate the political goals with that of the economic, and to try to have those two gel again that they used to do so well before.
And finally, one other asset class I wanted to ask you about, Treasury bonds. Treasury bonds down for the third year in a row now. It's the worst bear market in history since the founding of the United States. The 10-year yield so far this year has surged 80 basis points. It was up even more than that a week or so ago. And obviously the Fed helping here. I mean, in terms of the bear market that we're seeing in treasuries, although the last couple of days or so, there has been a bit of an unwind in that, hasn't there?
Yeah. So I think the FOMC have been pretty consistent in calling for stick for longer view. But I think middle of this year, the market decided to call it a bluff by thinking that there's going to be an earlier cut. So in this case, I'd have to blame the market watchers. And, admittedly, FOMC have sent out a couple of wrong signals over the past 2 years. So maybe it was in their minds expected that they will do it again. But I think I've stuck by my view that this current inflation will be sticky, that in a world where you have geopolitical risk rising, you have reversal of deglobalization, protectionism going up, and China disengaging from the world, that has to feed into inflation. And that, we cannot just use the easy tool of previous couple of decades of just simply cutting at the first signs of trouble. So I think the bond market and equity market is now perhaps for the first time bracing for a new world of persistently high. And it's, to be honest, 3-4% is not high, by the way. I think it's probably an appropriate level for financial markets to properly function and do its thing in providing fiscal discipline. So I'm a bit of an old traditionalist. I think that's not necessarily bad, seeing 3-4% interest rate for many years.
Peter, it's always a pleasure talking to you. Thank you very much for taking us through that. That's Peter Kim.
Thank you.
Who's Managing Director and Investment Strategist at GEO Securities in Seoul.
You're listening to Peter Lewis's Money Talk. Money Talk.
Thank you very much for listening this morning and this week. Don't forget to take a look at my daily newsletter, which you'll find at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then are Alex Wong, Director at Alex KY Wong Asset Management, and Tim Huxley, Chairman of Mandarin Shipping, and providing a view from mainland China will be NM Wu, the Chairman and CEO of Surfing Group. Have a great weekend.
Money Talk.